What's cracking, investors? It's Friday, July 15th, and today we're going to be talking about a very horrific topic. But before I get to it, I've got to do an account update. I have to review everything. I want to go through the positions, the options, the relative performance. I want to go into the investing tab, show you absolutely everything, where the margin sits, etc. And then after that, I'll blow my face up like this. So if you want to skip the first part, you can do so. And then I'm going to talk about this horrific subject, and everybody knows it, what it is. It's been weighing on us every day for like the last 6 to 9 months. And I'm going to go over some figures and some unbelievable stuff, and hopefully pose some good questions that I may not have the answers to. But let's go into the account first. This is the daily performance. I'm losing to the markets. I was down over 1% during regular trading hours, and then climbed back up a little bit over 0.5% in the after hours. So I'm going to go through the options positions. I'm not going to talk about them much. I'm just going to scroll through. You can see I have some new positions here, and then you can pause the video player at any moment to try to find out the exact positions and what exactly I'm holding. All the information you need is in this little box right here. So scrolling down, something of note. I know I said I wasn't going to talk about it, but I actually bought a $70 leap today that cost me like $2,000. So I spent $2,000 on this thing. I hope it works. I spent $1,950, and so far I'm down $17 on this PayPal. But I feel like, I know I'm going on a tangent a little bit. I'm going to finish the account review in a sec. But I feel like, look at this PayPal chart. You know what I mean? And this company is down at, when were they at 70? 2017. So they were at 70 in 2017. That's 5 years ago. 5 years ago of growing revenue and growing earnings and compounding and stuff. That's crazy. So I think the company is really undervalued. But anyways, back on track. These are my equity positions. Apple here gained 2.65 and still wasn't enough to put me in positive territory, even though it's my biggest position by far, like 3 times as big as the next position, which is Realty Income, I think, or I'm sorry, Mainstream Capital. So Realty Income up 0.5%, Mainstream Capital down 1%. You can see Goldman Sachs down 3%. Paramount, huge position, got clobbered 3.2%. Smith & Wesson down 2%, just crazy. And all the Chinese ADR leaps were down like 13-14%. So I'm just losing big. PayPal leaps were also down like 9% too. So big time loser here. Let's go over to the investing tab first, and then we'll do relative performance. Okay. So $280,000 under management here. Margin is 102,440 because of that leap that I purchased. So I purchased it on margin. However, if Apple goes over 150, I'll be selling 100 shares of Apple. So that might help decrease this margin a little bit. And if Main Street stays over 40, then I'll be selling 100 shares of that tomorrow as well. So that could help me reduce my margin a little bit. These are my stocks organized by total return. Apple is at the top, Realty Income second, Main Street Capital, DD Global in the green. I only have 10 shares for DD just because I wanted to see what happens. It's just a collectible. Equity size, you can see how big Apple is compared to the rest of my positions. $124,000. Next one is only $40K by Goldman Sachs. And then Main Street Capital, $40K. Paramount, $30K. Realty Income, $25. Smith & Wesson, $15. So Apple is huge. You can see it on this little thing right here on the wheel. 830 shares. Probably going to reduce a little bit tomorrow. We'll see what happens if Apple goes over 150 or not. All right, relative performance time. So Today I was down a percent. Week down 3%. Month up 6.6. 3 months up 2.69. 1 year chart is positive. I expected this to be negative. Interesting. All-time chart. When I do this, I gotta always disclose that I started investing in August 28, 2018 here. There was no money in the account before that. That's why it looks so flat. Okay, so negative 3% on the week. Let's see how the S&P 500 is doing. We're going to look at SPY, which is an exchange traded fund that tracks the S&P 500 index. So today I got beat. 1 week performance, negative 2%. Market's beating me. I'm definitely beating the market on a 3 month chart. Market's up 13%. That's bad. On the 1 year chart, I'm also winning because I was actually up 2%. Market's down 12.7. And 5 year chart, this is what the market did, up 56.85%. Okay, so that's the relative performance. Now I'm going to move into the topic today, which is, no surprise, inflation. And I just want to illustrate how bad this is. By the way, I have a really intimate relationship with inflation because where I grew up, the reason I immigrated from Bulgaria to the United States was because of a very intense inflationary episode there that basically caused us to leave the country so we can get food. Like, we're very poor, right? So we kind of sold where we lived to buy tickets, and that's all the money was good for. And that's how we got to the States. Now, as a family. Now, so I know a thing or two about inflation. I know how bad it is to live through it. But what amazes me here is some of these, asset classes that we're going to look at. They're supposed to benefit from inflation, and they're just not. So there's a very strange phenomenon going on here, which is like everything is tanking in real terms. I mean, everything, man. Like, you name it. Things that are supposed to be really good hedges against inflation are going down. Or just the dollar is getting such a huge bid, but yet that's the one thing that's been inflated along with all the other currencies around the world, right? So it's everybody is experiencing a destruction of wealth right now. So here's what I'm talking about, okay? Hedge number one that's supposed to really help against inflation, gold. What's gold been doing? Gold's down. So all these charts here I picked up on Yahoo Finance. They're year to date, okay? So just 6 month chart. You can see how it peaked out here early January, and then not January, but like, I don't know what that is, February, March. And then it's been going down with the rise of inflation and the big scares in the market. It was like over $2,000. Now it's $1,700. So that hedge is out, right? That's not been working during this inflationary episode. So like, what else? What else is good against inflation? Well, the market is good against inflation because stocks tend to stay about on par during hyperinflationary episodes, etc. But this isn't hyperinflation, it's just really high inflation. So let's see how the market's doing. Well, it's been going down. It had an okay bump in March here. And then it's down big time, right? We all know this. What's next? Well, another inflation hedge, of course, is commodities. So you would think that you'd be safe in a commodity index, like, for example, oil or other commodities, because obviously they get priced in dollars. So as the price the dollar goes down, commodities actually go up, right? That's how it works. Well, yes, that's true, but in the last month or two, the oil has really been taken on the chin. And in fact, I wish I could find a commodity price. Let's see if I can find a commodity index. Bloomberg Commodity Index future, okay? The futures. Let's see year to date. Okay. Hello? 6 months? 1 month. Anyway, 1 month, look, commodity index been going down. I don't understand why 6 month doesn't work. We're just gonna have to settle for the 1 month chart. Okay. Same thing. It's down. Commodity index was at like 130. Now it's at 111. Doesn't work. If dollar is inflating crazy, 10%, right, year on year, and commodities are going down. So, I mean, those are basically the entire, that's everything you can buy with dollars. Like, what else can you buy? Housing? Good idea. Maybe housing is just super, super, super high. And that's what's getting bid up. So let's check it out. Well, I think you finally hit the nail on the head here. Housing doesn't look like it's slowing down. This is from the this is Fred, our boy Fred. So there's the Federal Reserve website, and they publish all kinds of like data all the time. So this is median sale price of house sold for the United States. Now, everybody's talking how the housing market's supposed to cool, but it's actually not cooling. The housing prices tend elevated. I'll tell you what else is not going down is airfare. All right. So vacations, hotels, all kinds of like bookings like this, it's actually still not slowing down. So while everything that's invested is going down, all this stuff is not. What else is going? I don't know if cars are still up or not. I got to look at those inflation data, but currently the airline companies are reporting like record time profits, and so I guess that could be a place to kind of hide, but it's such a momentum trade. Like that thing's going to reverse in no time. Airlines never make money. They only make money for short periods of time, and that's it. And then they're in survival mode for like 10 years. So hotels, something's a similar story, I guess. Actually, I think the hotels are a better investment than airlines, but still. So that's kind of the only thing that's getting bid. But those markets are really small, right? Mostly the money's been going into the dollar. So let's take a look at what's been going on with the dollar, right? So this is the dollar euro, but it basically is the same thing as, dollar to everything else chart. Developed markets currencies chart, same thing as the euro. So year to date has been a straight line down with the market. That's the euro, by the way. So the dollar has been strengthening. Okay, so $1 €1 used to be worth like $1.15, $1.20, even earlier last year, at some point I think. But anyways, even on this chart, and now it's parity. Now it's exactly the same price as a euro. So the euro is no longer got a premium on the US dollar. They're worth exactly the same thing. So it's kind of crazy. So the dollar's strengthened against the euro by like, 20%. It's ridiculous. That's a lot in currency terms. Also, that's every other currency too. It's not just the euro, right? Like look at the Japanese yen. Look at this. This is absolutely crazy. This is in the reverse. So this chart going up means the dollar is strengthening. Okay, so basically it used to take 110 Japanese yen for $1. Now it's 138. Okay, so the dollar's strengthening like crazy. Absolutely insane. What else is on here? I think the British pound. Let's see how the British pound is doing. Okay, same thing. So the dollar is just going so strong against every single currency, right? That matters. So it used to be 135. Now it's 118 dollars per USD. Pound. Dollars per pound. So it's insane. Unless I'm reading that wrong. I think I'm right. It used to take $1.4 for every pound, and now it's 1.18. So a huge amount of strain, about 20% again, for that. So you're thinking like, all right, well, that means that treasuries are getting bid up and bonds, right? Everything's going in there, so they collect some yield on this really strong dollar. Well, not so fast. Let's take a look at the 10-year treasury, shall we? Boom. Yields are going up. That means no. People are selling the 10-year, right? So they're selling bonds. So those are the most liquid markets in the world. I mean, that's it. There's nothing else, right? So out of all of the markets, the only one that's still holding strong really against the dollar is housing, U.S. housing. Everything else is down. Like there's a little bit of correction here at the end last month. So I guess there's some bids going on the 10-year, but for the most part, over the course of this half year to date, it's been just a relentless selling of the 10-year bonds. So it's pretty amazing. And one thing that's happening too is that the 2 years actually like at the same rate as the 10-year right now. So usually this kind of inversion of the yield curve, that's what that means, is traditionally a good precursor for recessions. And I'll keep reading articles. Like some people have been saying, I think Deutsche Bank came out and said that the market's pricing a 100% recession. And I kind of agree. Like there's a lot of doom and gloom out there. So we'll see what happens with that. So anyway, but what I'm saying here is that they're not buying treasuries either. No, they're not buying bonds. So people, who are the people? Well, large institutions, individual investors, pension funds, you name it. People, participants, market participants, are choosing to store their value in straight up cash. Okay? Like dollars, US dollars, sitting somewhere in a bank account, recorded, right? That's what they're choosing to do, which is very interesting because it's dynamic that cannot last. The money has to go somewhere. Something's going to get bid up. I'm guessing precious metals are going to get bid up. I'm guessing the market's going to get bid up somehow, eventually. U.S. housing probably is going to continue to go up. So it can't last because if you just keep your dollars in the bank over the course of a year, you're losing, 9% purchasing power on those dollars. It's like buying a bond that yields negative 9%. That's insane, right? No one's going to do that for a long period of time. The money has to go somewhere. The value has to go somewhere. So it's going to spill into something. We're going to have to try to guess what it's going to spill into. Currently, it probably is spilling into short-term treasuries. Like I bet a lot of the money is just sitting in whatever the base rate is. I forget what they're called. Notes, bills. I don't know. Just like the 1 monthlies. I think there's a ton of money sitting in there right now, just rolling over really tiny percentages every month. But it's not gonna last for long. I think it's just a waiting game. But the thing is, let's say it gives 2%. It's still negative 7% per year. Like investors know this. Investors know that they're losing 7% a year by keeping the money there. It's just that right now, none of the alternatives look promising to them. But they will start. I'm thinking that gold is going to be a beneficiary of this eventual flow. Because gold, let's say you have, if you are holding gold in an ETF, right? You have an expense ratio of 0.25, 0.5, something like that per year. So that's the holding gold cost for you. If you're holding physical, I don't know how much it's called. Well, zero if you're just holding your house, but to keep it safe, I don't know, let's call it 2%. Let's say you have a 2% holding cost for gold. That's still, you know, that's still way better than having a negative 7% if you're holding it in cash or short-term treasuries. So you're beating short-term treasuries by 7% if you're holding gold. So that's pretty big. Gold usually does well in that environment, or should, but it hasn't been. But it hasn't been, and I think that's going to reverse. So I think gold's going to be beneficiary. What else? Housing is going to continue, I think, to be red hot, and also the market. Like the market traditionally, like no matter which kind of inflationary period I looked at, the market keeps up. Especially if you buy a nice well diversified like index, it keeps up with inflation. So I would do that. I think the market's going to catch a bit too. So I'm not afraid of downwards spirals at this point. I don't think. Like, yeah, there could be a flush out. Yes, there could be a grind lower for like a year or two. But I don't think we're going to see much more than like 15% down from here. And I'm betting against it. I mean, I'm not taking any insurance measures to try to protect myself against that downside, because that's not how inflation works. But, you know, that's just my guess. Obviously, I could be wrong. But I've seen inflation before, and that's not it. That's not how it works. I know that during the 70s, market grinded lower because inflation kind of strangled the consumer. There's different dynamics. I guess when you have the reserve currency, the dynamics are a little bit different. But just as a pure like mechanical common sense, everything priced in dollars will go up relative to that dollar, right? If there's a bunch of inflation. So I'm betting on those mechanics. All right, look, I think I've repeated myself quite a bit here, but hopefully I get my point across by showing all these things, how everything is just kind of getting sold off for no reason really. And I think it's just fear, and people just run to the dollar because it's the most liquid. But anyway, I think I've expressed my point here. I'm already over 20 minutes, like over 22 minutes. So I'm just gonna cut this short here, and hopefully I'll make another video tomorrow. It's gonna be an exciting Friday. A lot of options expiring, and also a lot of purchases and selling things in the account. So I can't wait. It's gonna be super exciting. All right, guys, that's it for now. Peace out.